You're probably wondering, how do you buy a car using infinite banking? In this video, I'm going to talk about how should you do it, or maybe you shouldn't do it. Tune in and find out why. All right, so you've probably heard something like, hey, I can actually buy my car using infinite banking, right? And it's been taught all over YouTube and social media. It's becoming kind of a hot trending topic even on TikTok. But the question is that really the thing we should be doing? Should we be using banks? Should we be using our infinite bank, using life insurance? Is that really the right strategy? Or are they lying to you? Let's talk about that here, because I'm going to reveal something that actually many people are not willing to tell you when it comes to buying cars with infinite banking. All right, so first and foremost, let's talk about how this actually works. How does life insurance work here, especially when we're talking about whole life insurance? Because there's death insurance. I call it, death insurance. It's just term insurance. Most people buy that kind of thing where you buy it, it's really cheap. It covers you for so many years. If you die during that time, your family gets paid. However, if you don't, then you lose it, right? If you don't use it, you'll lose it. We know we're all guaranteed to die someday, but term insurance is usually the option that people like Dave Ramsey will tell you to go for. So as a result, there are other things like permanent life insurance. You hear like universal life, whole life, things like that. Now, whole life insurance is different. It's not just a death benefit, although that does have a component to it, but it also has inside of it this tax-free savings account. This tax-free savings account in here is essentially, just like I said, is a savings account that you can use. It builds cash, it grows, you can even access it while you're alive. It's actually like a living benefit. It literally becomes like life insurance instead of just death insurance. And that cash value that's in there grows tax-free and can come out tax-free. It's like a Roth IRA, but it doesn't have all those stupid limitations and rules like 59 and a half. You have to wait till you're 59 and a half years old to touch it, or they might penalize you. Nothing like that. There's not even like a finance charge that's put on it. Now, if you do it like a loan and things like that, you borrow from the policy, then yes, there are charges. And that's the thing that really people start talking about. It's like, hey, you can use this to build it up. There's the infinite banking concept that's brought up by the Nelson Nash Institute, right? A great group of people. Nelson Nash, I'll tell you, was kind of like my start when I learned about infinite banking, because I didn't even know what this infinite banking concept was, even as a financial advisor. I remember learning about this first one in 2006 when I started meeting with other real estate investors and starting to get to know them, and they would talk about this infinite banking concept. And I said, well, what is that? They're like, oh, it's awesome. You use whole life insurance and use it to buy cars and you buy houses with it. And I thought, okay, why would you use whole life? Like, whole life insurance is the most boring insurance you could possibly get. It pays you like nothing. Now, I personally didn't know anything about it because I was focused on that cash value, that tax-free savings account, right? But I was like, I've heard it only pays 1 or 2% a year. And they're like, no, that's not true. That's not true at all. It actually pays dividends at that time, like over 6 or 7%, because interest rates are a little bit higher than now. Now it's like close to 6%. And so I thought, okay, I'm willing to learn about it. So I read that book by Nelson Nash, Becoming Your Own Banker, read that book, was intrigued. He talked about using it to actually buy things. It was kind of like the Dave Ramsey's version of, rather than trying not to go into debt, using your policy by borrowing from the insurance company, right? Borrowing that money, and then they pay yourself back. In fact, you probably have heard this in other videos about paying yourself back, right? Wrong. That's a half-truth. It's not a full truth. It's only a half-truth. And here's why. Okay, so understand this. You got to understand there's really 2 ways to access your money within a whole life insurance policy. I'm not talking about the death benefit, although there are some ways to access it while you're alive. If you have like disabilities or maybe a terminal illness or something like that. I'm talking about this cash value, this tax-free savings account. 2 ways you can access the money. 1, you can withdraw the money just like you withdraw from a savings account. Or 2, you borrow from the life insurance company so that your money stays in there. Now, what's the advantage of that? The advantage is, because many people talk about borrowing money from the policy. Well, you don't actually pull out your own money when you borrow. You're actually borrowing money from the life insurance company. Your money is there as collateral. They're willing to give you the money, usually about 90-95% of whatever's in your cash, they're willing to give you as a line of credit. Now, the great thing with this line of credit is, unlike a home equity line of credit or a credit card where there's monthly payments and sometimes really high interest, these are lower interest loans that do not require monthly payments to pay it back. Why? Because here's the magic of it, guys, is that cash value that's there, it's still earning that money. So for example, say you built up $100,000 in there, you want to borrow $50,000, you could withdraw $50,000, but now your $50,000 or your $100,000 becomes a $50,000 and you're earning less interest. But if I borrow from the insurance company instead, my $100,000 is earning tax-free dividends. Tax-free returns much higher than what a bank would pay me. So I get all that money, even on that full $100,000. But I am paying them interest. This is the lie. This is the half-truth that you always hear about. They'll always tell you, they'll say, hey, you pay yourself back interest. No, you do not. The insurance company acts as if they're the bank. Now, granted, there is no monthly payment, right? They're not requiring that, but they are charging you interest each and every single day. They're charging you daily interest. It is lower interest. Right now, they're usually between like 6.5%, maybe 7%, but they are charging you interest. So do not for one moment think that you just pay yourself back interest. That is a lie. What you're actually doing now is you're paying the insurance company as if they're the bank. You're paying them back interest. Now, the great thing is, yes, you're earning money over here. You might be earning roughly about 6% over here. So the two interests between the two of them kind of wash each other out. And in some cases, if you do it right, yes, you can actually earn more interest than what they're charging you because they're compounding interest over here while you're paying simple interest on this loan. But this is the big thing. When it talks about using infinite banking to buy cars, they'll tell you, oh, you just pay yourself back. And it's like no interest for you. That's only a half truth, guys. The truth is this, is that when I use an infinite banking policy for me, and I think more like a business owner and an investor. I know a lot of the people out there, they teach it like they're just insurance agents trying to sell you crap. If you understand the truth of this, you'll understand this is still an amazing tool. But the problem is probably because they design crappy whole life policies that are very expensive. You pay too much in fees than you should be. I get that. Maybe they're trying to sell you on something just to kind of get you all hyped up. But the truth is, guys, you are paying them back like they are the bank. At some point, that money does get paid back. Even if it just comes out of your death benefit, even if it comes out of the cash that you already have in there, you are paying back. So picture this, right? Imagine this, that you go and get a life insurance loan. You are paying back the insurance company at simple interest, just like you would for any other loan. You're trying to pay them back at about 6 to 7%. Well, what if you could get a 6% loan from your bank? What's the advantage? There isn't one. What if, in my case, last fall, we actually got into an auto accident, car got totaled, I had to buy a new car. I could have paid cash for it just fine. But one thing I've learned as an investor and a business owner is that cash is my friend. I need more cash in my pocket, more cash in my control, and heck, I like to have more cash so I can invest it to make bigger returns, not to just go buy cars. So when I went to go buy my car, I'm looking at options. I said, well, tell me your financing options. Even though I can pay cash, what are your financing options? They said, hey, you know what? We got a 3-year car loan at 3.9%. Now, those infinite banker guys out there, talking about this stuff, they'll say, oh, well, become your own bank, go get a life insurance loan. That's the best thing ever. Well, guess what? That loan will cost me almost double the interest rate compared to what I get from the bank. So I'm going to leverage the bank's money for cheap money. I love using bank's money, especially when it's cheap. So I got that 3.9% because why? I don't want to have to pay 6+% to the insurance company. That's why. I'd rather pay it to the bank, and then the money that I could be using from the insurance company, I use that money to go and invest and do some things with, like go and buy real estate investments, go invest in business and things like that that can give me better returns on my money. So I love leveraging bank money. That's why I love, not just for auto loans, I love getting a mortgage. I actually heard an infinite bank person on a video the other day that freaked me out. I was like, I cannot believe he just said this. He said the 30-year mortgage is the worst thing ever. Even though that 30-year mortgage could be cheaper than the bank loan you get from the insurance company, still he said you should not get a mortgage. You should use your infinite banking policy to do that. That is a bold-faced, stupid strategy. Because one, I just lost the liquidity of my own cash, and two, I'm probably still paying more interest to the insurance company than I would if I were able to get a lower loan. Now, granted, if the loan that I got from the bank, whether it's for a mortgage or a car loan, might be 9, 10+%, then yes, my policy makes sense because it's cheaper. But again, if I can get about the same interest rate anyways from the bank using their cash and their money, I would rather do that. So that's the thing, guys. Like, there's all these little nuances, but the truth is this, is that you can leverage your money so much better because I'd rather take that money I could have used to buy that car or even buy that house and go put down payments on other people's homes or other investment properties and things like that to make a heck of a lot more money and more wealth than I ever would just trying to pay off my own mortgage, which then again, I still have a loan on. Now, granted, I don't have a monthly payment. So that's true. There could be a peace of mind there because I don't have a monthly payment, but do not mistake for one second that they're not charging you interest. They are charging you interest, just like a bank would. It's no different than the 30-year mortgage, no different than the 5-year or 6-year car loan. It is the same. They are still charging you interest. But if you don't make any payments towards it, well, guess what? That interest now compounds against you. So you got to be careful not to buy into this. This is why they say you have to pay yourself back. Because if you don't pay back at least interest only, that balance will compound against you, and you do not want compounding interest over here while compounding interest is happening over here. Does that make sense? So the best thing you can do is, yes, you could buy cars with using your infinite banking policy. I would do that if you have so much cash burning a hole in your pocket you don't even know what to do with. But if that's the case, and you're like, well, I don't even know how to invest to make more money, well, maybe you should be watching some of these other videos on this Money Ripples channel to find out what else you could be doing that'd be way more impactful than just borrowing to pay off a car, which in truth, you're just borrowing from the insurance company to then pay off your car, right? And you're borrowing, yes, your cash is collateral, but you're still borrowing money, you're still paying interest. I'm not opposed to using debt, I'm not opposed to using interest, but you need to understand the truth of the matter and have eyes wide open that I'd much rather go for the lower interest rate, especially if I can get the same or lower with the bank versus using my own hard-earned cash that I can go working harder for me outside of those bank loans. That is the real secret. That's what I recommend. By the way, if you want to learn more about how you can actually design the right policy for you, go to moneyripples.com, click on Infinite Banking. We got a whole section on there about how to design the right one and how to use it the right way to create more wealth today.